Our next session is going to cover developments in the pipe market, which is an area that I know well, having written and edited 3 books on pipes. And really, pipes is, of course, the market that deal flow events got started in terms of our deal coverage and research products. So I'm certainly looking forward to this discussion, which is going to be held as a fireside chat between Matt McCloskey, Managing Director at iBanker Securities. Thanks so much, Matt, for joining us. And Glenn Paulner, who's a partner at Wilmer Hale. Glenn, it's all yours. Thanks.
Great. Thank you, and good morning, everyone, and thanks for having us today. I'm Glenn Paulner. I'm a capital markets partner with Wilmer Hale. We're an international law firm of about 1,000 lawyers. I help lead our SPAC practice, which is broad-based. We represent sponsors, SPACs, both in the IPO and de-SPACing process, target companies looking to go, private companies looking to go public through SPAC business combinations, as well as investors in pipes and other investments in SPACs, as well as the investment bankers that work with the SPACs, their sponsors, and targets. I'm happy to be here today with Matt McCloskey from iBanker Securities to talk about the SPAC pipe market. We'll talk a little bit about where we've been, where we are today, and hopefully a little bit about where we may be headed. With that, Matt?
Thanks, Glenn. Can everyone hear me? Yeah, sorry about that. It's good to be here with you all on such a nice day. I'm glad it's not too hot out. Makes it a lot easier up here. But my name is Matt McCloskey from iBanker Securities. iBankers, if you don't know, is a boutique SPAC underwriter that's been around the SPAC market since its inception. Since 2004, we've been an underwriter on 144 different SPACs. Now those roles were co-manager, joint book runner. We are currently active in target evaluation, target introduction for our teams. We've also have a unique perspective in that we've sponsored our own SPAC called GoodWorks Acquisition in the fall of 2020. We're quite proud of that accomplishment because 20% of the promote was dedicated to charity. We hope to close the transaction in the coming weeks and roll out another one. So it's a pleasure to be here with you all to discuss a topic that's become a vital component to the SPAC process in so many ways, and that's the pipe. Just to give you some statistics to give you a little context before we talk about the current state of the market. But I think Ben Kwasnick hit on a bunch of these numbers yesterday. But we've seen nearly $50 billion in pipe funds raised over the last 8 months. Let's see. So the range of pipes being raised is anywhere from $25 million to as much as $4 billion. On average, the size of the pipe associated with a de-SPAC has been roughly 15% of the post-money enterprise value, and 94% of the initial SPAC raise. So it's become quite a significant portion of the total raise. The pipe process really came to prominence back in 2020, and it coincided, not surprisingly, with a significant jump in the size of the companies that SPACs were targeting. If you go back to 2016 to 2019, the average pre-money valuation of a SPAC target was anywhere from 2 to 4 times the raise. In 2020, that number jumped to more than 6 times, and currently to date, we're up above 5 times. So it's really become an essential part. We just wanted to give you some of those statistics to provide some context before we discuss the current state of the pipe market, which I would say at this point is suffering from investor fatigue. I think there's really a few reasons why that is. I think the main reason is the competition, just strictly from the sheer number of pipes that are being marketed by SPAC teams to investors. I think another issue is the lack of a share price rally for SPAC transactions upon deal announcement. When you go back to the beginning of the year, we saw a number of transactions being announced. Stocks were rallying 10, 20, 30% in some cases, which really incentivized pipe investors to get involved and say, okay, I'm willing to commit capital to this transaction at $10 per share because I think, when the time comes, it's going to look like a good deal. I'm probably getting something at a 30% discount. We haven't seen that pop in a number of deals lately. So as a result, the pipe investors stuck with the dilemma: why would I commit to a pipe when I can go in and I can buy stock basically in the open market at the same price and still maintain my option to redeem if for whatever reason I don't want to be involved in the back end of the SPAC process. So I think that's one of the issues that we need to work through. And over the in the last few weeks, we've seen some transactions that have closed deals that have begun trading higher. I think that's the first step to getting back to where we were when we saw deals being announced and trading higher. That's going to be a really important part to free up the pipe market again. So maybe we just kind of jump right into it here, Glenn.
Sure. So, historically, it's sort of been taken as a given for SPACs and their sponsors and targets that you go out, you do your pipe, you're going to price it at 10. There's not going to be any warrants. You want to go out with a clean capital structure. In the current market environment, are you seeing any changes in terms of how the pipes are getting priced and changes in structure, perhaps with people looking at different types of securities, convertible debt, convertible preferred, other types of structured instruments? And when you think about those variations from sort of the typical model, what's the right way for a SPAC and a target to think about that and the perception associated with those kind of structures?
Well, we have seen, I guess the most recent example of a pipe process where you saw some sort of discount was JM City, which I think is merging with DPCM Capital. The effective price on that pipe was $8.42. It's a $100 million pipe. I think the concern there, when I look at that transaction, is that the minimum cash closing condition is $300 million. The pipe itself is $100 million, which means we've got to keep $200 million in trust. So that they're going to need to go out to investors and market the story and begin to get the traditional SPAC investor to either commit to staying in on the back end or find enough fundamental investors so that you don't have redemptions that are going to be excessive where you're not able to cover the minimum cash closing condition. The problem is when you have a SPAC that's priced at a discount like that, you're creating concern that the pipe investors are going to share because they have a lower, the pipe investors are going to sell because they have a lower cost basis. So I think it's going to be challenging to get $200 of $300 million in trust to stay in. So I think when you look at the various incentives that are out there, and the incentives can come in a number of different forms. It can come through warrant coverage. Typically, we see anywhere from 5 to 10% warrant coverage to pipe investors. It can come in the form of sponsors giving promote shares to anchor investors in a pipe. And then we're seeing situations where convertible bonds are being offered as well. I think the main concern for me when you issue a pipe at a discount is going to be keeping enough money in trust to close the deal. So if you're going to take the approach where you issue a pipe at a discount, you're going to want to raise a large enough pipe that's going to cover the entire minimum cash condition. Just you don't want a situation where you're scrambling trying to keep people in trust when you have such a pipe that's discounted compared to where these other investors are.
Great, and I know certainly from a SPAC perspective and a target perspective, if you look at the SPAC as opposed to, say, a traditional IPO, in the traditional IPO, companies are going out with clean capital structures, and so it's definitely a consideration where you're talking about a convertible or some other type of structured security, how the market's going to perceive that. You touched a bit on this, but what about transfers of promote, transfers of warrants, and what we're currently seeing in terms of sponsor incentives, in terms of trying to get the deal done on the pipe side?
I'm definitely seeing situations. We're involved in a number of different pipe processes where I'm seeing, tepid market reaction to initial outreach. So sponsor teams are going back and they're offering up a certain part of their promote to entice investors. Typically, you're looking at enough promote where you're going to get a 10% discount to the $10 price. So maybe you're trying to create a $9 stock for the anchor investors. There's no doubt we're going to see more instances of this in the coming months. There's just too much competition right now in the market. There are just, I think, too many SPACs chasing too few quality targets currently. But the economics are still favorable enough for sponsors that they can do that. They can offer up a good portion of their promote and look to offer that to anchor investors, and they're still going to end up with a handsome return on the back end. There's really, it's a choice between giving up a portion of the promote and getting a deal done, or running the risk of walking away from a transaction and bumping up against your deadline and having to liquidate. It's an easy decision for sponsors to go ahead and give up some promote in order to get a deal done.
Great. And in terms of any other innovations in structure you're thinking or seeing or hearing about, and I know you mentioned convertibles, maybe touch on that a bit.
Yeah, there's definitely been some situations. We've run into a couple situations where companies were in the midst of, maybe raising a convert privately, and then they've, in anticipation of merging with a SPAC, but they've made the decision to switch to, rather than raising a pipe on the back end, to just going a full convert, mainly because they've had, constructive conversations with investors leading up to that point. Maybe they see the convert as an easier way just to get the deal done rather than trying to take more time to try and close a pipe. So I'm definitely seeing more transactions like that with converts more involved. I am also starting to hear investors pushing back on certain incentives, maybe not asking for warrant coverage or promotes, but they're looking to have their shares registered upon business combination so that they're not tied up for 20 to 30 days or 30 to 60 days, whatever it is after the business combination. They want to have that potential liquidity upon business combination. That's another thing that we're starting to see in a few different deals. I expect that to become more prominent as investors start to push back as well.
Yeah, liquidity is a huge point for investors. We see that in all our representations of investors in the pipes. How soon are we going to be registered? What can we do in terms of hedging the position? Other issues around liquidity. Obviously, there's a lot of differences between a SPAC and some of the regulatory parameters relative to a traditional operating company, the lack of availability of Rule 144, the fact you're registering on an S1. So, we've gotten lots of questions, things relating to suspension of the S1 registrations in connection with the warrant issue, other issues associated with delays in registration, issues with respect to getting securities delegended. And then, on the timing, it's interesting in terms of the timing and registering right away upon completion of the de-SPAC transaction. Obviously, the registration also creates available liquidity that puts additional pricing pressure on the stock. And so there's already plenty of selling pressure around the closing of the de-SPAC transaction, and that just adds to it. But it's definitely liquidity is a huge point for investors. In terms of the expectations around the sponsor and what they're expected to bring to the table, either cutting their own checks or through bringing in friends, family, others, what are you seeing in terms of that today and relative to where we were a few months ago as well?
Yeah, I would say that the deals that are getting done now are getting done with what I call unique pools of capital. A lot of times sponsor teams are putting up more money. It's not, I think it provides a bit of validation to the transaction when the sponsor team may roll in a little more capital into the pipe. I don't think they need to anchor the pipe, but some sort of, we'll call it gesture to invest will certainly help. I think we also, are seeing family offices that don't typically invest in SPACs being targeted by sponsor teams to have them help round out a pipe book. I think we're starting to see interest from more strategic investors anchoring pipes as opposed to the traditional funds that we saw earlier in the year. The long onlys aren't as active. There's just too many deals for them to look at. So I think what's really getting done are those that are able to source unique capital, and that's really coming from in some cases the banks, but mainly from the sponsor teams. So I think when you look at the various sponsor teams that are getting deals done, it's the teams that have unique access to deal flow. I think companies that are management teams that have public company experience. I think they're attractive to potential targets, and those that have the ability to source financing on the back end, in addition to whatever the banks can bring.
Great. In terms of other changes, leaving aside valuation, price, structure, are you seeing other demands from investors, whether it's the degree of due diligence they're doing on transactions now relative to what we may have seen earlier in the year, this year, late last year, in terms of terms in the subscription agreements around closing conditions, seeking more in the way of representations about the target itself, which historically has been fairly light in the pipe subscription agreements or other things. We touched on the registration issue as well. Are you seeing anything notable in those areas?
I will say that the pipe process in general is taking longer than it was, just because there are a limited number of investors at this point. It's not as hot as it was. I think part of that we'll call length in time to get a deal done or to get a pipe done is because investors are spending more time on their diligence process. They're spending more time in the data rooms that the target companies have set up. They're performing background checks on both the SPAC sponsor teams and the new management teams. It is becoming much more of a process. I think when we look at the when they go through the data rooms, they're really starting to look for transactions where the numbers and the model are much more granular than they've been. It's getting much more challenging to get the pipe done, because I think there's some doubt about projections that have come across in the past. Maybe we've seen situations where some companies have stumbled out of the gate from the first quarter. Maybe they missed results, or maybe they've walked back their numbers, or maybe there's been some statements that have been made that could have been misconstrued as misleading. So as a result, we're seeing investors be much more diligent in their work, spending a lot of time in the data room and looking for multiple calls with the management team to make sure that they're not missing anything.
And from the legal side, there's always a lot of tension around that. I know we do spend a lot of time wringing our hands around, what information can be made available to the PIPE investors. Obviously, there's the expectation of the PIPE investors that they're going to be closed upon the announcement of the deal, and that tension around what information can be shared, while at the same time being comfortable from a cleansing perspective, whether we may see them enter into NDAs with longer duration, no trade provisions in them in order to get access to a more extensive amount of information. I think are all things that remain to be seen going forward. A lot of time has been spent discussing the warrant issue that arose over the last several months as a result of the SEC's pronouncement back in April. From the perspective of the pipe market, how has that been viewed? Has that kind of been a big event, or mostly viewed as less of an issue?
In my experience, it hasn't really been an issue, just because of where the pipe sits in the life cycle of the SPAC, and the warrant issue is relatively new. There has been some discussion with investors about the types of targets that SPACs can go after, just because the increased liability will result in maybe higher borrowing costs, or larger swings in the P&L. But at this point, when it comes to the pipe market, I haven't seen too much concern over how the warrant issue is going to affect them. But that remains to be seen. I'm sure we'll start to see more of it in the coming months, as the deals the SPACs that have gone out with liability accounting start to announce transactions. We'll probably pick up some new issues.
And in terms of pipe subscription agreements that we've been seeing since the warrant issue arose, it seems like investors have been fairly accommodating about providing carve-outs from representations around that issue, so you don't end up with a stumbling block later on with respect to reps around things like adequacy of disclosures and things like that. So seems like CCIV Lucid was a long time ago at this point. Pipe priced at $15, very noteworthy, because the pipe was priced above the traditional $10, also very noteworthy because it was priced well below where the stock was trading at the time as well. I know, at that point in time, having conversations with several of my partners around the pricing of pipes and fiduciary duties, the stock is trading here, you're pricing a pipe here, how does that all work? And you rationalize that. But do you think that if the market reverts to a place where we're seeing more SPACs traded at a premium to NAV, that we might in the future see more pipes priced above 10?
I am of the mindset that we won't see deals priced or pipes priced at a premium. I think an expensive lesson was learned for a lot of retail investors on CCIV and Lucid. I think the odds of a pre-deal SPAC trading at $50 in the future is very low. I think, like I said, it was an expensive lesson for a lot of investors. I don't anticipate too many pipes being priced at a premium. In the coming months, I do anticipate a significant amount of pipes being priced at a discount.
And in terms of, particularly in this challenging environment for pipes, are you seeing any deals go forward without a pipe, and any thoughts or wisdom for folks who may want to proceed on a transaction naked without the benefit of pipe or other committed capital?
So that used to be the standard practice, right? I think many people in this room probably remember when the pipes were not part of the SPAC element, and you had to go out and market to a number of investors and get them to go into the open market and buy stock and get the stock out of the hands of the potential redeemers. I think we are going to see more of that for sure. I do think some of the smaller deals that are out there will be able to get deals done without the benefit of a pipe or some sort of back-end financing, forward purchase agreement. But I think a lot of those deals are going to be, we'll call them like club deals, kind of inside deals, where maybe the sponsor is putting up any minimum cash necessary, or maybe an existing investor and the target company is going to put up more money. I still think the pipe is going to be a significant part of the process, but it's certainly challenging, because I think since May there's been somewhere around 42, 43 deal announcements. Most of them have had pipes associated with them, but 75 to 80% of those transactions don't have pipes that cover the minimum cash condition. I think that's going to be, we're going to revert back to where we were a few years back, where there's going to be much more focus on marketing to new investors, not just having the pipe take care of everything. You're going to have to go out and really start telling the story and, hitting the bricks again. Road shows will be easier now, though. You can just go Zoom instead of going from city to city.
Right. Turning back to another topic that the SEC has been focusing on recently, conflicts of interest that the sponsor has, conflicts of interest among the investment bankers. We see many, many more deals today where the financial advisor to the target is also acting as a placement agent on the pipe, where in that capacity they're actually acting on behalf of the SPAC and their sponsor. So there is some conflict potential there. In terms of the pros and cons of that arrangement, and for targets working with their bankers, what would you say to them in terms of the right way to be thinking about that?
Well, when I look at the pros of having a bank that's both the advisor and the pipe placement agent, is that bank is going to know the story best. They're going to know how best to market the story. They're going to understand the fundamentals of the company best. They're going to know which investors to market to, and I think that's an important component, because every SPAC has a ticking clock deadline. And to take time out to maybe run a process to hire banks and try to get interview 3 or 4 banks to see who could run a pipe process can be very costly. The timing can be really detrimental. So if you have an advisor that has the distribution, that has the reach, and has the ability to place a pipe, I would strongly recommend sticking with that bank. They're going to understand the story the best. When I look at the cons of just having an advisor be the pipe placement agent, I think it's the fact that you don't get the maximum amount of eyes focusing on your transaction. If you can bring in another bank, or maybe 2 or 3 banks that can help with research on the new company on the back end, I think that's helpful. I think bringing in a public relations firm to make sure that there's a steady stream of press releases from the time the deal's announced to the close of the business combination, I think that's helpful. I think that's the biggest con is not getting enough people to look the transaction if you're just using one bank as an advisor and a placement agent.
Okay, and I see we're running somewhat low on time, and we I think are what stands between everyone and a break. But in closing out, and then maybe leaving a little bit of time for questions if there are any, are there a few key points that you would make for sponsors and targets to try to ensure successful execution or to be mindful of as keys to a successful PIPE execution?
Yeah, I think there's a few things. One I just mentioned is, look to bring in a consortium of banks as opposed to just one placement agent. I think the more eyes on the transaction, the better. I think the PR firm, is definitely something that can be certainly helpful. I think you want to try to find targets where management and/or investors in the target company aren't looking to cash out completely. Maybe they're taking a little bit off the table. I think one of the issues right now is that PIPE investors are looking for any reason to pass on your transaction. So you want to try and limit the number of reasons they have to pass. So if you have a situation where there's an investor that's looking to take 60% of their investment off the table, I think you're going to have a hard time recruiting PIPE investors in a transaction like that. And I would say this, if you're struggling to get a PIPE done and you're thinking about going back and recutting valuation, or you're going to offer up some sort of incentive to PIPE investors, I would seriously take in the market feedback. I've seen situations where guys have gone out to the PIPE market, they see that it's challenged, and they've gone and just recut valuation without taking feedback from investors. They said, we're going to cut valuation 20%, just assuming that investors would care then. The result was that investors cared, but lower than the 20% cut. So you could end up working against yourself. So I would rely on, if you're struggling, rely on market feedback to really, before you make the decision, to recut your valuation.
Great. Well, I know we're out of time, but happy to take a couple of questions. We have one up front here, I know. Go ahead.
Hi, good morning. Thank you very much for the very informative and helpful discussion. My question is to Matt from iBanker on the issue of the investors' involvement in PIPE. Could you please give me an idea, if you can, how many percentage of the trust fund size is recommended for the sponsors' involvement in the PIPE, which could make the bank feel comfortable to join?
So I'm not sure I understand. So you're asking what percentage of the
sponsors' involvement in the PIPE?
Of the PIPE?
Yeah.
Okay. I don't know that there's a set percentage. I think if anything that is significant to the sponsor, I think something in the 10 to 20% range is, sends the message that the sponsor has a lot of conviction in this transaction, and they're going to work to do their best to get something done. I don't know that there's a set number, but I feel like something. If it's less than 2 or 3%, it's probably not meaningful. But I think something 10% plus is significant.
So my question is, the way you're describing the evolution of the participants in the market, it sounds like on the one hand you have these kind of very technical investors. They're looking for discounted shares. They're looking for immediate liquidity. On the other hand, you have potentially some strategic investors who I'm assuming, if they invest in size, they're going to be in there for a while. So as you're putting together these PIPE transactions, how much thought goes into how is this stock going to trade in the aftermarket, and how do you have, in an IPO, you're focused on orderly market conditions and trying to get the thing to, trade up, substantially so that investors get some reward for taking the risk. If everybody's running for the exits, it seems like that's very challenging, especially if they come in at a discount, whether it be through, free shares thrown in or whatever warrants or whatever incentives gets them to that basis. No, so how do you manage that, and how do you set the company up for success rather than just taking a big dump out of the gate and being marked that way?
So that's absolutely right. I mean, I think if you were to prioritize the investors that you target to anchor a PIPE, I think you want a strategic in there. That money is going to be locked up for a long time. I think after that you're probably looking for some sort of vanilla fund to be the anchor. You really don't want to get to the point where you're discounting the PIPE unless you need to, right? And then you're in a situation where I've got to get a deal done. I'm going to do whatever I can to get that deal done, or else I'm going to lose my risk capital. So I'm going to offer this discount. That's the worst case scenario. But even the worst case scenario for a sponsor isn't all that bad. If you have to discount a PIPE, it's better than losing all your risk capital. They do. I think, yeah, I don't know that they certainly learn throughout the process, right? I know in a lot of conversations when we're talking with our targets, especially a lot of them that are raising money prior to a SPAC transaction, we ask them, are there any strategic investors that would look to be involved in the pipe? And we do, in most situations, find someone to do that.
Great. With that, I think we'll conclude. Thanks, everybody, and thank you, Matt.
Thanks, Glenn. Thank you, everyone.